I am the founder of therationaltrader.com. We're going to talk today about order flow. The Rational Trader is mostly about helping you understand two sets of challenges that you face. Today's discussion is technical, the technical challenge. The other challenge you face is related to the natural biological response or physiological response that you experience when you put money at risk. And I'm not going to go through the entire list here, but we need to talk about risk. When you put money at risk, your body responds to that. And you must understand that issue and deal with it, or you cannot be successful. Trading is risky. You can lose all of your money. If you're dealing with any kind of leverage, in fact, you're likely to lose it all. That's what the data shows. And so understanding where the risk is critically important. Okay, so we're just going to, the biology issues related to trading, we're just going to we'll just brush the surface today. But if you find that what you hear today resonates with you, there's a wealth of information on the site that I encourage you to check out. We're going to talk today about order flow. This visual is a very good representation of the situation that you're in as a small account trader. You're that little guy. You'd like to be the big guy, but you're not. The big guy is really the large institutional traders. And what you often hear is that you'd like to figure out what those big guys are doing and do that, follow along. That's actually quite difficult to do. It's difficult because they're much better capitalized than you are. And they can withstand normal price fluctuations that you can't withstand with your small account. You can't take that much risk. They're also better skilled, technically and biologically, and so you have to deal with that issue as well. All right, now I've got about 15 minutes of prepared material. We're going to, and then we'll spend the rest of the time with the charts. I want to say one other thing before we continue here, and I didn't give you any background for me. We don't really have time for my personal history. So I'll just say this, I'm a trader. I run a live trading room. I trade live with real money in front of people every day. I have a very clear idea of what it means to be a trader and what it takes to learn how to trade. Okay, so let's switch to the chart real quick. This is the NASDAQ on Thursday, 2 days ago. And what you can see here is, let's get oriented. So this is 6:30 in the morning Pacific, 9:30 Eastern. All the times you see here will be Pacific. I'm on the West Coast. And then this gray area is a blackout period. It's the first 5 minutes. I won't take any trades during the open or other news events. Horizontally, there's a couple lines here. This is the opening price. Here's yesterday's close. This would be Wednesday's close in this case. The previous high day is right there, and the previous low is right there. These are very good to keep you oriented in space to see where you are. Okay. You can see here that we sold off overnight to the tune of about 30 points, and then we opened up right here. I have this marked here because we set an initial low right there. Okay, so let me put a line there that we're gonna come back to that in just a minute. Whoops, let's try that again. All right, now the market opens up and it trades up and then sets this level right here. Okay, now the question that I have for you before I tell you, what is order flow and why do you care about it, the question I have for you is, who is buying right there? Who's buying right there on a break of the high into the previous day's close, no less? Think about that for a moment. One of the things that I mentioned that institutions are not buying here, almost certainly not. One of the things that I said was like, look, you're taught to try to figure out what the big guy is doing and do what he's doing. But there's another approach. You can try to find the little guy and compete against him. So trading actually is unusual in that you have some control over who you compete against. It's not like almost any other walk of life. If you're a professional tennis player, you only get to play against other professional tennis players. But in trading, to the extent that you can find them, you can trade against less skilled traders, and that's who you'd like to trade against. I want the person on the other side of my trade to be not as skilled as I am. All right, let's go back. So who's buying right there? Buying a break of the highs, a very the market's gone up 15 points since the open. Okay, I shorted it right here. Okay. Now, there's another question though, right here. This was the low that was set earlier. Who is selling right there? Who's selling on the break of the low? We're going to come back to this chart in a minute after we've talked about what order flow is and what it can tell us and show you how it describes why that's a good choice to make. I actually went long here as well. I went long right there. Okay. So let's leave this on screen right here. We're going to come back and add some stuff once we understand what is order flow and how we can make use of it. All right, so let's get back to our presentation. Now, we're going to start with the basics. Order flow is simply the way the orders are executed in the market, the way they're transacting, the way they're flowing into the market, hence the term order flow. Yeah, Steve, I'm going to answer your question in about 10 seconds. You're just a little bit ahead of me. So when it comes right down to it, it's, you know, is there aggressive buying? Is there aggressive selling? Is the market moving very quickly or very slowly? Is there a lot of volume or a little volume? All the parameters that govern the amount of trades and which direction they're going. Okay. Now it used to be called tape reading, and this is exactly what they did. As the trades would execute, as they'd come across the wire, they'd read the ticker tape, and from that they would try and, well, some people were quite successful at figuring out what the market was going to do based upon what they saw on the tape. All right. Let's see, how does demand and supply enter into this? Hang on, Cookie, we're going to get that. Now, with the advent of computers, we have another way to look at it. All right, we don't have ticker tape anymore. This is a time and sales window, and so if you open this up, you'll see the trades, you know, scrolling up or scrolling down as they transact in the market. Red is for a sell, green is for a buy, et cetera, et cetera. Now, I know people who can open a time and sales window like this and watch the market move and figure out what to do. Now, I could never do it. I tried and tried and tried. I thought it would be incredibly useful to have this as a way to confirm that what I'm considering doing is not, I'm not going to get crushed. Okay, or I can see in the order flow that this idea is sound. This trade idea is sound. I could never do it. I think the people that can do it they've made a deal with the trading gods or something, or they've got special trading juju that I don't have. I tried and tried and tried. It's all just noise to me. All right, but with advances in computing power and some pretty creative people, we have other ways that we can represent this information. And that looks like this. I call this is a volume by price chart. Just hold questions. We're going to cover this chart in a lot of detail today. By the time we're done today, you should understand what this chart is showing you. There's a lot of information here. It's the same information that's represented here. It's just visually set up a different way. All right. If you can figure out what's going on in here, you can drastically improve your understanding of what's going on in the market. Particularly, what are the other people doing? What are the other market participants doing? And if you can figure out what the other market participants are doing, then your own choices will be of much higher quality. All right. There's a problem with this chart. There's a bunch of problems with it, actually. The first thing is that if you're just looking at this without a lot of practice, it's really hard to figure out what's going on. All right. The learning curve is pretty steep. Now, for newer traders, there's an even bigger problem, because as the market is moving, as the trades are transacting in the market, this chart, these numbers are updating hundreds of times per minute. And as a newer trader that's still struggling with the fear, anxiety, and doubt, that is your natural biological response to putting money at risk, it's very, very difficult to make a decision, because you're getting inputs into your emotional machinery so fast that it can be hard to actually make a decision. So one of the things we'd like to do is remove the noise from this chart to make it easier to make a decision. All right. Now, the key thing that I like about order flow is that it helps you tell a story about what's going on in the market. And as humans, we relate very well to a narrative. If you can tell yourself a story about what's going on, it makes it a lot easier to understand what it is that you should do. Now, before we can go any further, before we can parse this, we have to understand what it is that we want to see. Once we understand what it is we want to see, then we got to figure out how can we remove the noise and make use of it. So we're actually going to take this data and apply it to the regular chart you saw earlier. Okay, so the first thing that we want to see is called absorption. And in my example here, the market is moving up strongly. There's lots of buying. Buy, 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 buy. Very aggressive buying. A question that will come in is, how do we know it's buying? And I'm going to explain that to you very clearly in just a moment. We're seeing lots of buying, aggressive buying, buy, 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 buy. But then the price stops going up, even with aggressive buying. And what that means is every trade has a buyer and a seller. If there's a lot of buying, but the price is not going up, it means sellers are stepping in and absorbing all of that buying. And I like to think of it just as you see there, a sponge. The sellers are soaking up all that buying, and you'll either get a pullback in the continuing trend, or that's the turn, that's the high. It could be either one. The same is true for selling. Sell, 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 sell. Lots of selling, aggressive selling, but the price stops going down. All the selling is being absorbed by buyers who are taking the other side. Okay? Absorption is the first of the three things we're looking for in the order flow data. Okay? The next thing we're looking for is exhaustion. Now, exhaustion, I've represented it here by a decreasing font size in the term buy. So you're seeing less and less buying. But it actually happens in one of two ways. One is either a gradual decrease in the amount of buying, or it can be very dramatic. You've seen a lot of buying, and then suddenly there's a dearth of buyers. There's nobody left to buy. All right, and it's like a runner. I'm just running out of steam here. Whether it's a marathoner like this guy, or a sprinter who went as fast as he could go, and then at the end he's just out. He's blown. He's done. He's exhausted. And it's the same thing. Either this is just a temporary pullback, or you could have found the turn. Now, it's the same for selling. Or this example is for buying and then shorting the market. There could be dramatic selling, and then suddenly there's no more sellers, and the market turns. All right. Exhaustion is the second thing we're looking for. The first is absorption, lots of buying, but the price is not going up anymore. The second is exhaustion. Suddenly there's no more buyers, and the market stops going up as a result. The third thing we're looking for is acceleration. Acceleration is I'm seeing buying, lots of buying, the market's moving up, but then I suddenly see lots and lots of selling, not just a little bit, a lot of selling. relative to the amount of buying. Lots of people are stepping in, taking the other side. So relative to the amount of buying I saw, suddenly now there's just a ton of selling. The sellers are stepping in and going the other direction. Same is true for if the market was falling. You're seeing lots of selling, lots and lots of selling, and then suddenly you see a lot of buying, and the market accelerates away from the turn. Hang on, Zena, we're going to answer that question. Now you also see this in combination. Here is acceleration up, and then you'll see acceleration down. This is, I call this paired acceleration. You see the market just screaming higher, and then it immediately starts to scream the other direction. Okay. You also will see two of them together, like exhaustion. I ran out of buyers, and then I suddenly see lots of sellers. And when you see this on the same bar, actually, very powerful signal. I ran out of buyers, and the sellers stepped in and took it the other direction hard. And of course, the same is true for if the market's falling. Lots of selling, but then I run out of sellers, and the buyers step in and take the market in the other direction. Now, the question is, how do you see these things? All right. And to answer that question, we have to understand how the trades are transacted in the market, because the first thing you have to understand is are the buyers or the sellers dominant? Is it aggressive buying or aggressive selling? This is a standard DOM you're looking at. There's a 10 level deep bid and ask. I need to draw on this, so I snapped a picture of it, and I want to talk about how the trades transact in the market, and from that we're going to figure out what the order flow data is telling us, and then how we can make use of it to make decisions in the market. If there is heavy buying, doesn't there need to be buyers? Well, every trade has a buyer and a seller. Okay, this is a little difficult to wrap your mind around. In fact, it boggles my mind when you think about it. Millions of contracts are traded every day. I'm a futures trader, so I think in terms of contracts. Millions are traded every day. And every single transaction has two people on either side, each of whom have a different view of what's going to happen next. Millions of times per day. Every trade has a buyer and a seller. So let's look at this. What do we see here in the DOM or the order book? On the right here, this is contracts on offer. This column is referred to as the ask column. I'm asking for this amount of money, or the offer. I'm offering to sell this to you for this amount. So right here, what we see is there's 35 contracts on offer at $48.45. 35. Let's assume each person is selling one contract. 35 people are saying, if you're willing to pay me $48.45, I'll sell to you. It's a passive order. It's just waiting there for the price to come up to it. Below that, 48.44, 25 people. 25 people saying, look, I'll sell to you. 25 contracts are on offer at 48.44. If you're willing to pay that amount, I'll sell to you. All the way down to 48.36, where there's currently 4 contracts on offer. Okay, all of these are passive orders. They're sitting there waiting. This is very key to understand. These are limit orders, is what they're called. On the buy side, it's the same. On the buy side, here, whoops, I've got 10 levels deep of people that are willing to buy at a better price. Down here at 48.26, there's 28 contracts on bid. This is the bid column, or the bid quantity. I'm willing to pay 48.26, but I won't pay any more. I'll buy from you if you're willing to sell to me at 48.26. At 48.30, the sort of the high volume node here, 52. So 48.30 here is a popular price. If you're willing to sell your contracts at 48.30, I'm willing to buy from you. These are passive orders sitting in the order book. Now, up at 48.35, there happens to be also 4 on bid. So there's 4 people willing to buy at 48.35 and 4 willing to sell at 48.36. It's just coincidence that it's the same number. Now, here's the key. What has to happen for the next trade to occur? What has to happen? You've got a bunch of limit orders sitting on both sides of the market. Currently, if the next trade, for the next trade to occur at 48.36, someone somewhere in the world has to step up and say, I'm willing to pay more. I'm willing to pay you 48.36 for your contracts. That's a market order. That's an aggressive buy. So if the next trade occurs at 48.36, I know that's an aggressive buyer. I don't understand your question, Steve. Highest amount goes first. If the next trade occurs at 48.35, that means that someone somewhere in the world was willing to sell for less. That's a market order to sell. The only way that these orders get fulfilled is if a market order comes in and executes against it. Someone is either aggressively buying or aggressively selling. It is the only way a trade occurs. And so the software will keep track for you. Well, good software will. Where did the trade occur? Did the trade occur at the ask? Did the trade occur over here? If it occurred over here, if it traded at the ask, that's aggressive buying. If it occurred at the bid, that's aggressive selling. Okay. Can we know who is buying? Big banks, market makers, etc. We can make some good inferences. Okay, you'll see in a moment. All right, so to review this, this is such a key thing, I want to say it again. For the next trade to occur, somebody somewhere in the world has to either step up and pay more or step down and pay less, accept less. Okay, so a buyer's has to be willing to pay more for the contracts, or a seller has to be willing to accept less. And the software will track where did that trade occur. If it occurred at the ask, that's a buyer. That's aggressive buying. There is a seller on the other side of that trade, but the buyer was aggressive. If the trade occurs at 48.35, then it's the seller who was aggressive. The seller said, okay, I'm willing to accept less. John, that's a little too deep for today's discussion, but you can come to, I'm going to invite you all to a tutorial on Saturday. We can talk about your question there. So now, let's go and talk about how this information here gets laid out into this, well, that chart, okay? So we're going to do that actually in the live charts. How are we doing on time? All right, so this chart here is the volume at price chart. I call it, when I'm trading, I say, let's look at the print. This is the same period of time, okay? Here's at the peak here, 416 at 644. Let's make sure I got that right. Yeah, 416 at 644. All right, so it's right there. Now, the way that this chart works, some very creative people came up with this. If the trades occurred at the bid, if the trades occur at the ask, if it was aggressive buying, then it fills in on the right side. So in the same way that this, well, let's do it this way. In the same way that the right side has the contracts on offer, and if the trade occurs at the offer or at the ask, that trade is going to show up on the right side, the right column. There's 2 columns here. So everything you see on the right was an aggressive buy. On the left side, it's the opposite. It's the aggressive sells. So the selling is on the left and the buying is on the right. That's just the easy way to think about it. The selling's on the left, the buying's on the right. And so what we want to do is we want to look at the buying and the selling relative to what price is doing, and from that make some decisions about who is transacting in the market and what are they doing. All right. Keeping in mind that what we're looking for is absorption, exhaustion, and acceleration. All right. There's a couple other things on here that you're probably wondering. The green line up to the left or the red line is if the bar closed up or down. Now this is an 8-tick range bar chart. What that means is that the market's going to trade inside this range, 8 ticks high, until it breaks out. And then you'll get a new bar. So you could be in this bar for a second or 10 minutes or 20 minutes or even longer, however long it takes for the price to break out. So as it's trading, it sets the 1675 is the high of this bar and 1475 is the low. It'll trade inside that until either 1450s trade and you'll get a new bar down here, or 17s trade. And that's what happened here. And so this bar closed up. The green line is helping you see this bar closed up. The other question that will come up is the yellow rectangle. That's the high volume node, the price level at which the most trades occurred. Okay, useful for helping you understand where to place orders and things. Now, when you look here, what do you see? You see right there. I can't really draw my arrow very well. 104 buys at the top of the bar. 104 people went long right there. But the bar closed down. You're looking at absorption. 104 buys. A lot of people bought right there. Now, by contrast, here, as we break the high, remember this was the high that's been set by this bar. How much buying do you see? And in fact, right there, 13. So on the way up, there's 104 here. The market falls back, and then when you break this, this mini swing high right here, only 13 contracts go off at the high. 14.7 compared to over 100. That's exhaustion. I ran out of buyers. So we can represent this in a much simpler way. All right. If we just turn on the order flow study, the yellow triangle is absorption, and the blue diamond is exhaustion. And now that I have this, I don't need this chart anymore. I can just do the same thing over here. I can just turn on the order flow study. And now I can start telling myself a story about what I'm seeing here. All right. So let's go back. Here's the open, the flurry of the 5 minutes here. You can see a lot of buying here. Price can't go up anymore, and the market turns. And then you accelerate. You're accelerating away into exhaustion, and actually you accelerate away. This is a strong signal by itself if you're an aggressive trader. Up here, this is key now. You break the high on exhaustion. That's a sell signal. And I shorted right there. So what you've done here is you've identified where people have gotten themselves into trouble. They've done something foolish. You broke the high on exhaustion. There's nobody left to buy. The market's going to fall. This is a range bar chart. It doesn't have a time frame. Range bar. So if you're not clear on what that is, Google it. There's a couple of great sites that can explain it to you. I don't have time to do that today. I've got 9 more minutes here. Now, let's go look at the other setup that we talked about earlier. This was the low of the day, that yellow line. It was set over here. Okay, it was set right there. Now, right there. Okay. Now, the question was, who is selling right there? Let's bring it over. Who's selling right there? Who's shorting the lows, right? We think it's almost certainly not institutional traders, big traders. But look what you see, actually. Absorption. Let's go look at that bar. Let's go look at the print. This means there's a lot of selling in the bar. There's a lot of selling as you broke the low, but price is not going down. What time is it? It's 7:30. Calling the price. Here it is, right there. Let me make it a little bit bigger. Okay. You see that? 124 sells. In fact, there's a lot of selling here. 90, 90, 124, 85, 50. We're still a fair amount. All right. So that's where the absorption is coming from. It means, look, there's 124 contracts that were sold at 0150. That means that there were also 121 buyers, right? Because every trade has a buyer and a seller. All that selling got absorbed. With this much selling, the price should not be going up, it should be going down. Now you can also see buyers stepping in right there. It's a little more advanced. 199 buyers. Okay. So we talked earlier about, well, who's selling here, right? And we believe we found the foolish little guys. But we also found the smart big guys, because they're the ones that are taking the other side. I went long right there. And the concept behind this trade setup is these people sold here, and in my view, it's a very foolish thing to do. And the market set this level right there, right? And then actually, it actually came down and retested that level. This is now a very powerful signal, because you had a lot of selling down here. And if you're a big trader and you want to get long, you need sellers. You need someone to take the other side of your trade. And you know that there was selling interest here. And so the market comes back down, you can see it right there. More selling coming into the market, more selling coming into the market. The big traders are absorbing all of it, because look what happens. The market doesn't keep going down. And in fact, as soon as, let me get rid of these lines, hold on. As soon as this level here is breached, the people that sold now know they're in trouble. So this particular trade setup is based around finding the people that have done something foolish, and then identifying the point where they understand that they're in trouble, and that's when you enter. So I went long right there. Let's look at questions. Let's see what happened here. I don't remember. Oh yeah, this was that really long, ugly consolidation here. It took forever going sideways, and then before it finally broke out. Let's see. Yeah, exactly. There were some stops down there, yes. So there's two sets of people that are selling here. All right, if this was the low. Let me go find it again. Here's the low, right? There's two sets of people that are selling when you break that low. Some of them are the people that got long, and it's their stops. Others are people that have gotten excited about the market crashing or going down, and they're selling. Both of those people are getting hosed, because the bigger traders here are absorbing all that selling and sending the market higher. Is this like on balance volume? they're related. But mostly we're talking very specifically about what do we see happening here. All right. You'll notice here, we go sideways here for a while. Let's go a little bit further down here. That was overnight. Here, you come back and retest the high. Where's the high? It's right at the purple line, okay? Look what happens. Absorption, a lot of buying, but I can't go higher. And then I nick that level, and I run out of buyers. Exhaustion. That's the high. I shorted, what did I do? I shorted there and added there, I think. I don't remember. You can go watch the daily video. The trade is taken live on the site. And so what we've done here is you don't have to look at this chart. All you have to do is read what the market is telling you. This is a great example of what a consolidation looks like. You'll notice on each edge you're getting absorption and exhaustion as the market continually tests that range. And it breaks out and doesn't go anywhere. It all gets absorbed, and this is a very powerful signal that the market's done going up. Absorption, that level gets tested, and then you exhaust, you run out. You ran out of buyers. You actually executed at 2050 and 2075. But you're out. There's no more buyers. The market's going to fall. It's just a question of finessing your entry at this point. It's very clear what's going to happen. If we look at that print real quick, and then I'm going to invite you to a tutorial where we go over this in more detail. 1051. Let me find it real fast. Too far. It's right there. 135 buyers. You also see big selling stepping in, aggressive sellers stepping in. 135 buyers, 98, and then when you break it, 42, 0 at that level, 1 there. You ran out of people willing to buy. Okay. All right. Yeah, so what I'm going to do here is I'm going to invite you to a free tutorial next Saturday where we talk about, it's the actual trading program tutorial that I use every day. Okay. And let's see if I can do this correctly. Or Reed, can you send it? Let's see. Send to all. Okay, here's a link. And what we're going to do is we're going to spend 4 hours. I can never do it in less than that. Next Saturday at 11 o'clock, okay? And we're going to go over the order flow trading program tutorial. And we'll take what we've discussed here and talk about it in a lot more detail, okay? And let me get the presentation back up. So sign up for that. It's free. There's no cost, okay? And coming out of that, you'll have a very clear idea of, is this something that resonates for you? Is it useful? Or is it just not for you? It depends. For some people, it seems like magic. Oh my God, this is the thing I've been looking for. It dovetails nicely with lots of other systems. I've got a lot of members that are technically skilled. They've got a method they use, and you add the order flow thought process, and now they're very, very happy with their technical approach to the market. I trade CL and NQ daily live. I'm going to be adding either bonds or the euro next, probably bonds, but we're not there yet. And so we'll talk actually the indexes and like a commodity market like oil trade completely differently. So it's very interesting that how you see the order flow telling you what's going on in these two different markets. Oil is a much thinner, much whippier, much faster market than an index market. Does this work on equities? Anything with volume VL. Anything that has volume, you can apply this concept, okay? Because you can tell who's buying and who's selling, who's being aggressive on which side, but what is price doing? You compare that to what price is doing. If you're seeing aggressive buying and price is not going up, the market's going to turn. The platform is in Sierra charts, okay? These are custom studies that I wrote to do this, to remove this noise. My service, I charge $95 a month, and I don't charge members for the studies. There's no extra cost. It's just $95 a month. My goal there was to make it easy to try. All right, I want to remove cost as a barrier to entry, so there's no hidden costs. A lot of times you see something you like, and then you discover you've got to spend a big amount just to get the indicators for you to work, for you to get your charts to look the same. That's not the case here. You can sign up for a trial, actually, and you're a full member for the 7 days of your trial. I think I'm done here. I want to end with this visual, okay? When you're trading, you are in competition with everybody else. Nobody is your friend. Everybody wants your money and will take it from you if you're foolish enough to give it to them. You're dealing with a probabilistic environment, so you're going to be wrong. Wrong is not the correct term. You're going to take trades where you lose money because you're dealing with an environment with a large random component. All right. But if you're smart about how you approach it and you protect yourself from your own biology, and you deal with the fact that you're in the live environment, all things that we talk about at the Rational Trade about how to set yourself up to protect yourself, then you can begin the journey to success. And what you want is, you want to be this, what you see on screen here. I love this image. You can look in that cat's eyes and you can see he is the apex predator and he knows it. And that's who you want to be. You can be it. You can be the predator. You don't want to be the prey. So many people are the sheep or the zebras out in the market. Okay. All right, Reed. I'm done for today. So I encourage you to join me next Saturday. We'll spend 4 hours together, and you'll come out of that with a very deep understanding of how order flow works and how you can apply it to your trading.